Let's talk money. Mary Holm is here, personal finance expert. Hi there.
Hi, Jessie.
Nice to have you. And what is on your mind this week?
I'm worrying about mortgages, Jessie. I mean, they're such a big part of people's financial lives. Of most people lucky enough to get to the point where they actually have a mortgage, of course, these days. Although, that's going to settle down around the country, I reckon. But, we can't have too many New Zealanders not wanting homes and not having them.
Yeah.
But, that's not today's topic. Today's topic is more about how to handle your mortgage, different moves that people make. And there were a couple of sort of worrying trends that got me onto this topic. One was reading recently that people are moving from 25-year loans to 30-year loans.
Right.
And
what is the standard?
The standard was 25 years, I understand.
Why?
But goodness knows, I suppose. It's over the years it's probably evolved a bit.
I suppose so.
It depends on interest rates. I think probably if we went back to a time when people were paying 10, 12 and 15 sort of percent mortgages, probably the terms were longer then because it does decrease your monthly payments, of course. But currently with mortgage interest rates pretty darn low by historical standards, the drift to changing from 25 to 30-year mortgages, I just want to sort of point out to people why that's not a great idea.
Great.
And I decided to come up here with a typical mortgage amount and quote a few numbers to people,
yes,
so they
please.
get a bit of a feel for the sort of numbers we're talking about. And that was an interesting exercise, coming up with what's a typical mortgage. It depends on what part of the country you're in.
Sure it does.
And I landed on 400,000 in the end, although, in Auckland these days, that's not going to get you far.
No.
But it would get you a long, long way in smaller towns and in places like Dunedin. So that's what we're going to work with, 400,000. For anyone who's sort of taking notes and watching the numbers diligently, and if you're in Auckland and your mortgage is 800,000, just double all the numbers. It's quite simple. Yeah. So
it should scare you away, the idea of a $400,000 mortgage or 800, but you get used to the idea.
Yes, and you have to really if you want to own a home. Yes, the idea of borrowing nearly $1 million is scary, but you've got years and years to pay it back. I mean, we don't want people to sort of panic about that, but at the same time just be aware of how you can kind of play the mortgage game to win. So looking at a $400,000 mortgage at 5%, let's say, if you change from your loan from 25 to 30 years, and you can do that. It's not just people getting new loans. If you've already got a loan and you're having trouble paying, you can go to the lender, and quite often they would let you extend the term. And that means you're going to be paying roughly $200 less a month, which is, a big help to some people, although we're moving from about $2,400 to $2,200 a month. So these are very rounded numbers to give people, a rough idea. So in some ways, moving from $2,400 to $2,200 doesn't make that much difference. And the point is, if you made that change, you would pay $71,000 more in interest over the life of the loan, and that's real money. It's a bit of a tendency when you're looking at all of these big numbers it feels like you're in a foreign country. You know how sometimes with a foreign currency, sometimes you're paying 100 somethings for a cup of coffee, and after a while it all gets kind of meaningless.
Well, you go to Club Med and you have to use those little beads.
Yeah, I've never been to Club Med.
Well, someone else is paying for me, Mary, but it becomes meaningless, doesn't it?
Yeah, it does, and that can happen with these mortgage numbers. But the thing is, if you made that change from 25 to 30 years on our typical mortgage here, you would be paying $71,000 more over the time of the loan, and that's real money that you could have a lot of lovely holidays with, or do the house up with, or something. It's big.
I mean, it is a decision, though, isn't it? You might say, well, actually, I'd prefer to have more money in the back pocket each month over 30 years and lose out on that.
Yes.
If it makes life a bit easier. I mean,
that's quite right.
I'm on your side, but but it is a choice, isn't it?
You're quite right, and if you're really struggling, that $200 a month would make a difference, would put shoes on the children, then do it. But just don't do it too readily, because it's $71,000, which is a lot of money. It's worse still if people go to interest-only mortgages, and I don't know how many of them are being offered anymore. They have been in the past, certainly more on rental properties, I think. With those, if you're paying interest-only, then your monthly payments are lower, but they're not all that much lower, actually. And you're not making any progress. You're not getting the mortgage down, And I mean, that's one of the happiest days of people's lives when they make that last mortgage payment. It's a real pity.
I remember the last payment of my student loan. That was a good day.
Yeah. It's a lovely feeling. So really avoid the temptation to go interest only, unless it's, say, for a short time. If you've lost your job and you're finding another job, that makes sense. But generally speaking, it's not a good idea. And another trend that's also been worrying me is people adding to their mortgage because their house value's rising. And, we've seen that in Auckland, and now that the house values are rising all around the country, that's going to happen more.
You feel rich all of a sudden, don't you?
Yes, you do. Yeah, you've got a $500,000 house, $400,000 mortgage, and then they tell you your house is now worth $700,000, and you woohoo, let's go and borrow a bit against the house and have a nice time. Especially if you've been struggling to meet the mortgage payments. It's tempting to just or struggling to make everything work financially. Tempting to just add, $20,000 more to the mortgage and go and have a lovely holiday. And look, I'm not saying that you should never do that, but do it with your eyes open. So assuming here, I'm going to assume that someone who's doing that, who's adding to their mortgage, has probably already switched to a 30-year mortgage just to try and make things work. So going back to our $400,000 5% mortgage again, if you add $50,000 to the mortgage, you're going to be paying $270 more a month. But the point is the total cost will be $97,000 more. So you've borrowed $50,000 more, and it's going to cost you nearly twice that. It's going to cost you $97,000 because of
that
all
doesn't
the
include the
extras.
extra $70,000 you were talking about before. You're just saying that extra $50,000 will
Yes.
cost you $97,000.
Yeah.
Amazing.
Yeah,
It's an expensive
so
holiday.
It is, yeah. So think in terms of actually paying double what you think you're paying if you borrow extra against your mortgage to, say, go on a holiday or
That's incredible,
get a
isn't it?
new car when you don't really need a new car. And it's different if you need things.
Bernard
But,
Hickey, the
yes.
economist, is listening, by the way. He
Oh, is
says, over 30% of owner-occupiers and over 60% of landlords use interest-only loans. It's high.
Oh, that's interesting. Good on you, Bernard. That's useful. Yeah.
30% of owner-occupiers.
Yeah, yes, that's really quite depressing. I suggest they go and have a look at what the payments would be. There's online calculators all over the place. Every bank's got one, etc. What your payments would be if you went on a 30-year loan instead of interest only. You might find your monthly payments aren't that much higher.
They're banking on the value of their home going up.
Yes, they are.
And taking care of that principle.
Especially in the current environment, that's risky, and it just also it's not good psychologically, I don't think, to feel like you're going nowhere.
And it's out of your control too, isn't it?
Yes, yeah, it feels kind of scary to me. It's kind of on slippery ice there.
Okay.
So have a look on a calculator and at how much more it will cost you, or ask your lender how much more it will cost you to have a 30-year loan, and you might find it's not that much more. Now, where are we here? Just pointing out to people too that if you're doing these sort of things like adding to your mortgage, interest rates very well might rise in the future. Probably not in the next year or two. We're not talking about that. But if we're talking a 30-year loan, they could easily rise. And we had one listener to this program emailing in a while back that said they were paying 6% in 1971, and within a decade they were paying 26% on their mortgage.
But this time is different, Mary. It's your favourite phrase, eh?
That's right. It's never different. Well, look, it probably is different. It's very hard to picture that because that was partly because inflation went crazy. But you should never count on mortgage interest rates staying at the level they are. That's scary business. On a more positive note, got some good news here. Quite a lot of the big banks are saying that because interest rates are pretty low now, it's encouraging people to repay their mortgage faster than they have to. So they're making extra payments. BNZ, for example, a while back said 43% of its customers are ahead. They've got ahead on their payments, and that's really good news. And
Yeah.
love to see more of that happening. A basic idea with mortgages is that when interest rates drop, maintain your payments, keep them at the level they were. Typically, a bank will let you do that, and they should make it easy for you to do that. So, for example, back on our $400,000 loan, 5% for 25 years, our basic loan we're looking at here. Okay, so it's at 5%. If interest rates drop to 4.5%, you're going to be paying a bit over $100 less per month if you go with the rate drop. But if instead you stick with your old payments, you can save $26,000 in interest over the life of the loan. And that's, once again, that's real money. It's money that you could have at retirement to do a round-the-world trip or buy a new car or something like that. It's real money. And you'll pay the loan off 2 years faster as well, which is all. So it's a really neat idea if interest rates drop. And they might do that in the next few years, probably not a lot, but who knows? Whenever they drop, try really hard to keep your payments at the level they were at. You managed it then, so keep managing it, And
if you pay your mortgage off 2 years faster, that also means you have an extra 2 years of earning power, right? And money that was going to your mortgage going into your retirement or whatever.
Yeah, and that can make a big difference. So the whole it's a real win-win to do that. On the other hand, when interest rates rise, you're going to have to just swallow it and get and pay the new money. So when they rise, you've got to go with the flow. When they fall, don't go with the flow. Keep your payments as the way they were.
I guess the other option when they rise is for you to stay with the same payment and extend the term of your mortgage. I mean, you wouldn't recommend that, but that's a choice,
right.
Isn't it? It's an option.
Yes, it is an option. And all of this, it's, once again, it's so nice for me to just sit here and say people should be doing this and that and the other thing. And if you're really, really struggling to, as I say, put the shoes on the kids and feed them, etc., then by all means, go for some sort of release, but challenge yourself on that. You don't always need those new clothes, etc. If there's no interest rate change and you want to get stuck into your mortgage, you could go to the mortgage lender and actually reduce the term. You can sometimes just go to them, probably always just go to them and say, look, I just want to pay an extra $100 off a month or something like that. But you could also sort of to kind of rein yourself in, to be perhaps more disciplined about it, reduce your term from 25 years to 20 years. And if you do that, you'll be paying $300 more a month, so quite a lot. These are all rough numbers. But you pay $68,000 less in total on your mortgage. So that's, once again, real money. So these are, these numbers are big. Yeah.
Is there a penalty for doing that? Actually, shall I read this next letter that you've got?
Sure.
I might address that. Could you ask Mary Holm, says one of our listeners, Kate, whether what my father always said still holds? Get rid of debt if you get extra money. I have extra money coming in due to a contract I've signed. We have $200,000 on mortgage paid at the moment by a tenant. Are there some penalty clauses for early repayment? We have about $120,000 in shares in KiwiSaver and $35,000 in cash. We live rent-free on family land and are both nearly 65, and my husband still works full-time. Sounds like things are going pretty well for them.
Yes, aren't they lucky? They're living rent-free on family land. Sounds like a pretty nice deal. So first of all, I want to just talk about, in general, about whether Kate's father was wise when he said he always said to pay down debt. And yes, generally speaking, that is a really good idea. The return, if you pay down a mortgage, a 5% mortgage, for example, it means you're getting out of paying 5%, and that's the same as earning 5% on the money you've paid it down. So if you pay down the mortgage by $100,000, then and you get out of paying 5% on it, that's the same as investing the $100,000 and earning 5%. We've talked about this before,
yes.
But it pays to repeat it because people don't always realise it. It's also a very low-risk thing to do. And getting rid of your mortgage gives you great security. So if you lose your job, or if you want to start a business or support the family or something like that, you can generally borrow back again against the money you've paid off early, and it gives you all that flexibility to do all kinds of different things if you need to. Do be careful, though. Kate asked about some penalty clauses for early repayment. They tend to apply to fixed rate loans. I don't think there are any floating rate loans where that applies,
No.
but a lot of people have got the fixed rate loans, and that's because the bank doesn't necessarily, they've got a fixed contract with you, they don't necessarily want you to start changing it. It actually depends what direction interest rates are going at the time. So go and ask the bank if their penalty applies. In some cases, they're quite happy to let you pay off early, and quite often I understand they will, even under other circumstances, let you go into them and say, I want to pay regularly $50 more a month or something like that, and they'll let you do that. So go and ask.
Yeah.
It can't ever hurt to
I
ask.
try to do that unusually, because when you first get a mortgage, you've got no idea how it's
No.
going to impact your life. You
No.
do your budget, but you don't really know what it's like to live with a mortgage.
That's right.
And we found a few months in that I budgeted my mortgage payments a bit low, and I went in,
Yes.
and they said that I could turn it up by about, I think it was 15%.
Did they?
I don't know
Yes.
if it was just my bank or that's across the board, but
Yeah.
they would allow us to, increase the payments a wee bit to a certain amount.
even though it was a fixed rate loan.
Yeah, that's
Yes.
right.
I think that is pretty much across the board.
Otherwise, you've got to wait till the fixed rate is
Finish
yeah.
your term ends, yes, of the fixed rate. So, for the reasons that there is some inflexibility, I do suggest that people have some of their loan be floating. So if you're getting a $400,000 mortgage, you might get $100,000 of it floating. Tends to be a higher interest rate these days, but it gives you that flexibility of paying money back if you want to. But now moving on to Kate's letter here, though, there's an interesting point there. Her mortgage is on a rental property, she said, and that makes things a little bit different when mortgages are on rental property. So the interest is tax deductible, so that means it costs you less. And I just want to work through that because people don't always understand that. So with the mortgage interest we pay on our own home, there's no tax break on it. There is in other countries, but there isn't. Like in America, you can, and that was great. But in New Zealand, you can't deduct mortgage interest on your home, but you can on rental property because it's treated like a business. So, for example, just to work through an example here so people understand what that means, with our $400,000 5% mortgage that we've been talking about, the interest on that is $20,000 a year. You're paying interest on that. And so you can then deduct that from your income, and it means that you're no longer going to pay tax on $20,000 of income. You've subtracted the mortgage off it, and so that becomes tax-free. So the tax that you would have paid on that $20,000 is roughly $6,000 if you're a sort of middle tax bracket person. Roughly speaking, you would have paid $6,000. So that means that you've paid $20,000 interest on your rental mortgage, but you've saved $6,000 on your tax. So you've netted out $14,000. So it's actually only cost you $14,000, not $20,000 in total.
Yeah.
I hope that makes sense. It's a bit hard to follow, but
yeah, but the basic message is if you've got a mortgage on a rental property, there are extra reasons to keep that debt rather than paying it off.
Yes, it costs you less. It's in our example there. It's instead of being a 5% loan, it's basically a 3.5% loan.
Okay.
And that's sort of for roughly the rough numbers for people in a sort of middle tax bracket. Don't make my friend's mistake. She once said to me, "Oh, look at I get taxed. This is tax deductible," and therefore she doesn't think she pays it. She's got rental property, and she was saying, "Oh, look at I pay maintenance on the property, but it doesn't matter because it's tax deductible, so I don't have to pay it." And I said, "That's absolutely not true. You have to pay about 2/3 of it. The other third you get off your tax, roughly speaking."
Okay.
So yeah. So roughly, very roughly, if people's taxable income is, in middle or upper tax bracket, take about 1/3 off the interest you're actually paying.
Okay.
Yeah.
To the next point, and we've got a letter for you. Mary, I have $70,000 in savings and a $60,000 mortgage. I'm planning on building a new house. Am I better off paying the existing mortgage of $60,000 with my savings and taking out a building mortgage for the new build, which could be 300 or 400k, or am I better using the savings for unforeseen cash expenses before the new build?
Yeah, so this person's just got the money there in their savings and not sure whether to whack it off the mortgage now, knowing that they might need to use it quite soon. And generally, as I say, it is a good idea to pay mortgages down. What I would suggest for this person is to try and see if they can get a revolving credit mortgage. They probably can. I think all the banks offer them these days. So basically then this person could pay their savings in and reduce their mortgage in the meantime into that revolving credit mortgage.
So you get the benefit.
Yes, you're getting. It means that the savings is reducing the interest you have to pay, and then borrow back as and when needed. And so in the meantime, because it might be a few months before, I think it's a he, needs the money again, you're getting the benefit of a big reduction in your mortgage
make your money
payments
work
in
for
the
you.
meantime. Yes. The only big basic warning about revolving credit mortgages is you do need discipline. You're basically given a big loan, and the bank says, you can borrow up to, if you go into the bank and want a $400,000 loan, they might make it $500,000, for example, and you can borrow more as you need it. Not a good idea to borrow it to go on holidays and things like that. You want to try and keep the balance as low as possible on that loan.
Yeah.
So if you're not
I've got some friends who just went on a family holiday, and I said, was it expensive? And they said, I've got no idea. We've got a revolving credit account, so we never know whether we're up or down. I'm the same,
Yeah.
It's really hard to keep track of, of where you're at with that revolving credit. It goes up, it goes down.
It might be a bit hard to keep track of it, but if you get indulgent with it, you are going to end up not having such a nice retirement. Now, your friend might say, bugger that, the retirement's, on the never, never, and I can't argue with that. I mean, it's money now versus money later, but it's more money later. If you sacrifice the money now, you'll have quite a lot more later, is how the numbers work.
You just want to make sure as you're going up and down, that you're slowly moving in the right direction,
That's
not
right.
the wrong direction.
Absolutely, yes.
Okay. Any final points on this week?
Oh, just a couple of just sort of main points, because I hope I haven't been too confusing on this. But if you extend the term of your mortgage or you add to your mortgage, it costs you a lot of money to do that. And repaying your mortgage fast saves you a lot of money. They're tens of thousands of dollars we're talking about, and this is real money. It's money you could be having fun with. If interest rates fall, keep up your old payments, and repay a home mortgage before a rental mortgage is the other one, because the rental mortgage is tax deductible. It doesn't cost you as much. So get the home mortgage down and before you tackle a mortgage on a rental property.
Right. Nice to have you on.
Pleasure, Jesse.
Personal finance expert Mary Holm, who's in once a fortnight on a Thursday just after 2:00.